the government is now strongly hinting it's considering changes to the capital gains tax discount, and a growing number of prominent voices have thrown their support behind a change. Radio National Breakfast political correspondent and economics reporter Tom Crowley is in Canberra for us this morning. Hi there, Tom. So what could a capital gains tax reform look like?
Hi Mel, well there are plenty of options circulating around and plenty for Labor to consider after a week where we've heard from all sorts of experts at a Senate committee that was convened by the Greens but has landed at a very convenient time for Labor. It's all about the capital gains tax discount, and Labor politicians are almost not hinting anymore. They're just getting very, very close to the line of saying that they are actively considering changes to the capital gains tax discount, although they emphasise that no decision has been made, no policy has changed yet. But this was a policy that Labor took in some form to the 2019 election, and it's something that's been on the Labor horizon for a while. The capital gains tax discount applies when assets are sold, not the family home, that's exempt, but investment properties, shares, other types of assets. They get sold, they get taxed when you sell them at whatever your income tax rate is, but there's a 50% discount. And that is in part reflecting the fact that when you hold an asset for a long period of time, there's some inflation in the mix and you should be compensated for that inflation, as well as broader arguments that you should have some sort of discount on the taxation when you're investing your money somewhere. So they're two of the principles for the capital gains tax discount. But in general, it well and truly overcompensates a lot of people for inflation, and most of the benefits go to people at the top end of the wealth scale. And so that's part of the reason why there have been arguments to curb it. One of the policies which Labor took to the 2019 election was to halve the discount from 50% to 25% across the board. That policy was grandfathered, which meant that Labor couldn't be accused of changing the rules on anybody who had bought a property, an investment property, expecting a 50% discount. Well, they would still get it, but any future purchasers would have a 25% discount attached to them when they eventually were sold. That was the proposal back in 2019, but there's also been speculation that if Labor does want to go down this path, it might revert to the system for capital gains tax discounts which we had before 1999, instituted by the Hawke-Keating governments. This was a system where inflation was simply calculated over time. It's a complex calculation. If you've held a property for, say, 25 years, to figure out exactly how much of the increase in its value was due to inflation and to deduct that from the taxable amount. But that's how the system was pre-1999. There's a general sense that the ATO has better technology and is perhaps better placed to make that an easier calculation these days, so that could be one option. Other numbers get thrown around like 33. These are the games that we're left to play when the Labor politicians are not yet clear, as I suppose you wouldn't expect them to be in February when the budget's in May, about exactly what their plans are. But we've heard from a number of different experts before the committee this week, speaking to the intergenerational components of this. There's an argument with capital gains tax, like negative gearing and some other elements of the tax system, that they benefited one generation at the expense of the next generation. Of course, we know the baby boomer generation and Generation X, to an extent, have a very large number of investment properties, relative certainly to what the millennial generation has so far been able to achieve. Overall, $1 in every $6 invested in Australia, 16% is invested in investment properties. So that reflects that feature. And when young people are struggling to get into the housing market, to the extent that we have had clear clues from Labor, it's been that they're interested in tackling whatever they tackle from an intergenerational housing perspective. So that's the summary of the tea leaves, I suppose, Mel.
And so, Tom, I guess what are some of the risks for Labor if it does choose to go down this path?
Well, just like any tax reform, Mel, there are opponents to this idea. And really, I mean, any change at all that increases taxes is something that Labor will be worried is politically toxic. This is exactly the experience it had in 2019 when capital gains tax changes, you might remember, sat alongside negative gearing changes, franking credits, trust tax changes, and the whole package was one that was ultimately difficult for Bill Shorten and Chris Bowen to sell to the electorate. There were complicated details that they had to get into, and it was a tough sell. The coalition's already preparing the line that Labor can't fix their budget, so they're coming after yours, and have made it clear that they will attack really any form of tax hike. And in particular, they're suggesting that raising or making the CGT discount less generous would essentially be raising taxes on investment properties, and therefore you would get less housing. So Labor might have an incentive to try and design its proposal in a way where it could argue that it's actually boosting supply. Maybe a more generous treatment for new homes under tax law could be a way for them to do that. So there are a few different obstacles there for Labor to consider. There's also, some arguments from Bill Kelty, the former union heavyweight, from the Business Council as well, that this should be considered as part of a broader tax reform package and that overall it should be revenue neutral. For instance, perhaps there could be some income tax cuts with whatever money you raise from a CGT change. So lots of things for Labor to consider. But one of the other things that we've heard this week is that there are quite a few advocates of a change as well, including many of the people who appeared before the committee, many economists, but also the Commonwealth Bank CEO, Matt Comyn, who spoke on 7:30 last night and said that the intergenerational argument was a strong one. Here are some of what he had to say.
I think as part of a broader package of reforms, I think that's certainly something that should be given careful consideration. I mean, a big part of intergenerational equity is there's too much of a burden on Labor, in terms of people who are working, paying too much income tax.
So the intergenerational argument that Matt Comyn's making there, clearly I think the strongest political argument, given that there's so much recognition that the housing market is a tough one for young people today. But these questions of design are important for Labor because if they do grandfather it, if they do try to, make the changes less contentious and narrower in their scope, well, they'll also do less about this intergenerational problem because so many decades where this discount has existed, the housing market has moved in the direction that it has. And if you're grandfathering a policy, well, you're not exactly winding back the clock. So again, plenty for the Cabinet to consider.